Hello, Scott Thomas here with Stewardship Matters. In this video, we're going to talk about taxes on retirees. So how much of your last dollar did you actually lose to federal income tax? Here is a tax map. As you increase ordinary income from left to right across the bottom, you can see the rate should intuitively be applied to the next dollar. And here is the tax map for capital gains and dividends. Notice the 0% all the way to $75,000. Let's do a quick study here. So we have effective rates. So we have John and Jane. They're both married. They filed jointly. They're both over 65. They have $50,000 of combined income. They have $15,000 of long-term capital gains this year. And they have $25,000 IRA withdrawal. So we assume that they need $60,000 in after-tax spendable income. All right, so here is the tax map. You can see once they've harvested a little over $10,000 in ordinary income, they begin to experience a 10 and 18.5% effective marginal tax rate. That's the point at which their ordinary income plus their capital gains drags enough of their Social Security into the calculation to begin making every additional dollar withdrawn from the IRA taxable at 10%, and each dollar over that drags another 85 cents of Social Security into the mix, creating an effective rate of 18.5%. You can see this couple never really experienced the 10 and 15% brackets. They go from 18.5 to 27.75 to 55.5 before dropping down to 30% and back to the regular brackets. So you're saying, wow, how did that happen? How did that spike happen? That, you think that it's going to be a 15% tax bracket, and then how did it get to 55%? So intuitively, here's what actually happens. They withdraw $1,000 from their IRA. So it's taxed at 15% or $150. That caused $850 of Social Security benefits to become taxable, adding $127.50 to the bill. Then together, that caused an $1,850 of the capital gains that would have been at zero to become taxable. Thus, the $277.50 all added together equals $550 or 55% tax. So we have a similar effect with capital gains. If the couple were choosing whether or not to sell a stock at a $40,000 gain this year, they would certainly want to know that the portion of the sale that would actually lose 40% to federal income tax. Maybe it makes sense to not only sell part of the position this year, but maybe 35 of the gains this year and maybe some next year to avoid the spike. The fact is that there's a lot of ways to control taxes, and planning in advance is an important part of an efficient tax retirement program. So diversifying among different accounts, have different kinds of tax treatment, using tax-deferred products while appropriate, blending withdrawals from different account types rather than simply harvesting in sequential order, and paying close attention to what types of investments you hold and which your account that can make a difference in the tax efficiency in your retirement income. So if you want to reach out to me, you can reach me at scott@stewardshipmatters.net. That's scott@stewardshipmatters.net.